One last thing I wanted to ask you real quick. We've used this word edge a couple of times.
Right.
A lot of our traders are not familiar with this word edge. I've used it on the floor. Edge to us was basically having a spread in there. In other words, if we had an option that was worth $1, the ability to buy it for 90 cents or sell it for $1.10. Mm-hmm. How do you define edge as a closing thought?
Just simply, an edge is just a higher probability of one thing happening over another. That's all. Just a higher probability of one thing happening over another. But keep in mind that within the context of what we've been talking about, it's a higher probability happening over another over a series of trades. A series, okay? So in other words, you know, like for example, what I do is I teach people to trade in sample sizes.
Right.
So that instead of saying to themselves, I'm going to take the next trade, I'm going to take the next 20 trades.
Right. I'm going to keep myself in the game.
I'm going to keep myself in the game and see what happens over the next 20 trades. And then if I get the kind of results that I like, I'll take another 20. If I don't, I'll tweak my methodology so that I get better results.
Mark, it's been great. We'll see you back in a couple minutes. Guys, it is time for a break. We want you to get your questions in for Mark. You can give us a call at 1-866-WTV-WISE. That's 1-866-988-9493. Or you can send us an email to trader@wisetradetv.com. When we come back, we will answer your questions and talk more about psychology in today's markets. We'll see you back here in 5 minutes.
Jared are still here and ready to answer your questions. You can give us a call at 1-866-WTV-WISE. That's 1-866-988-9493. Or you can email us to trader@wisetradetv.com. Guys, Mark, that was a great show. I loved all the information you gave everyone.
Thank you, Susan. Thank you very much.
Thank you so much for being here. I know at Wise Fest everybody was thrilled to actually get to meet you and see you in person. So it's a special pleasure to have you as a special on WTV.
Thank you. Different for me. I've never been on live TV before, so this is.
Well, you're doing a great job.
Thanks.
Well, you know, guys, we have lots of callers and emails to no surprise. So why don't we get right to the phones?
Let's get going.
We have a call from Brandon in Massachusetts. Good morning, Brandon.
Hello, guys.
Brandon, hey.
And lady.
Good morning. What's your question for Mark?
It's not really too much of a question. It's mainly I'm a complete clean slate. I learned how to trade through Wise Trade. I didn't know anything before, and I just thought you guys want a perspective of not knowing anything. And your analogies that you used were great. It really made me understand what's going on. And what I just want you to comment on what I've taken from it. That's okay?
Yeah, we'd love to hear it.
These are the things that I've gotten. Why is trading not guaranteed? It's because prices are determined on predictions of what other people will do. And technology can record what other people have done in the past, but cannot predict what people will do in the future. Right?
To a point, yeah.
No, they can predict what people will do in the future, but just not on a trade by trade basis. In other words, you're going to get it's like I'm going to go back to the coin. What Wise Trade or technical methodologies do is give you a weighted coin. Where if I've got a coin that says that 70% of the time that you flip this coin, it's going to come up heads, then that's what your technology, that's what your technical methodology does. It gives you that whatever percentage edge. It just means that on each individual trade, which is what the tendency that most people have to do, is they try to figure out if this trade is going to work, not if the next, not what's my percentage of wins to losses over the next 20 trades, or the next 10 trades, or the next 100 trades.
That's a good point. Edge.
Edge. That's a good point, Jared.
Edge.
Okay, Brandon, well, thank you for calling on that. We have another caller. It's Miss Amber in California. Good morning, Amber.
Hey, Amber.
Susan, Jared, Mark, hello.
How's it going?
Good to hear from you.
Oh, yes. Hey, you know what? Thank you, Susan. Mark, thank you so much for being here.
Thank you.
Your book,
My pleasure.
Trading in the Zone, I read it cover to cover. I love it. I think it's neurolinguistics for trading and for traders. And I loved what you said about scaling out of positions. That made so much sense to me.
There are little bits and pieces in that book you know, that a lot of people don't. It's not just, you know, blanket psychology. I mean, there's so many little intricacies in that book that'll help you with your individual trading if you pick them out. Talk about scaling out. Where did you come up with? I mean, obviously. Where it occurred to me to scale out was back when I first started trading. Well, not exactly when I first started trading, but while I was working at Merrill Lynch at the Chicago Board of Trade as a retail broker, by the way, and I used to keep meticulous records, and I would analyze my trades, and I found that. That rarely did I get into a trade where it just stopped me out immediately. In other words, where the market never gave me anything. In other words, I get into a trade, let's say I bought at 10, and next thing you know, price is at 9. It never went to 11, okay? Right. So that was maybe 1 out of 10 times that would happen. And then I saw that there was a certain percentage of my trades where it went, if I bought at 10, it would go to 12 or go to 13, and then go back through my entry point and stop me out at let's say 6 or 7. So it actually gave me something, but I didn't take it because I was looking for something more. And so what I did is I analyzed my trades in this way and put them into categories in terms of the percentage times that it would go in my favor in relationship to when it didn't, and found that I could give myself consistent results if I started scaling out. In other words, I would take a part of my position off at a very small amount. Let's say, just to make it easy, I trade a lot of silver and gold back then, but just to make it easy, where I would take a first third of my position off at, let's say, 3 or 4 cents in silver. Okay. And what that would do is that would not only make me a winner from a psychological perspective. If you really want to look at this, psychologically, what you want to do is you want to create a belief. You actually want to create this belief inside of you that I am a consistent winner. Right. And what will happen is that when that belief gets integrated into your mental, as part of into your mental environment as part of your identity, as long as, of course, the steps that go into making I am a consistent winner are consistent with that belief. In other words, it becomes a part of your identity, and you just function out of that belief in a way that you don't even have to think about it anymore. That increases your confidence.
That's right. It not increases it; it's just who you are. So, in other words, if I want to actually believe that I'm a consistent winner, then I have to do something that creates that. So, by taking off at least a third of my position with a small amount, what that would do is that would reduce my risk. So if the market did go back and stop me out, it wasn't stopping me out of my whole position, but if it didn't, then of course I had a spot where the next third came off, and then a predetermined spot where the next third came off. And now the problem with scaling out that a lot of people have is that if they get into a monster trade, the loss potential of, if I had the whole thing on, I'd just made so much money. But again, it's like, what's your objective? If your objective is to get those monster trades, then it's going to be inconsistent with producing consistent results. So you have to be clear about what it is that you're trying to accomplish.
I really like that, Mark, because there are a couple of things you said that I really like, and one is setting yourself up for success. And it's sort of like what you do with your children when they're smaller. You want to reinforce the positive things that they're doing correctly, because then they know, you know what, I can do this. And so by taking those profits as they're coming, you do have that mental state.
Absolutely. It's really critical. It's really important. I think it's one of the most. Once people get some of the fundamental skills out of the way, it is probably the most important thing they can do for themselves. Is what I call take money as the market makes it available. Have a plan for taking the money as the market makes it available, because we don't know how far it's going to go.
I do something called kibbles and bits, where I just say, you know what, I could just try and grab 5 and 10 cents. I know that with my trading, from what I've done in the past and based on the tool that I'm using, it's very easy for me to grab 10, 20 cents out of each of my options. Now, if the option costs $2 or $3, that could be 30% or 10% of my trade, depending upon the cost of the option. So little bits and pieces, just trying to eke out small wins, and then again, instills confidence, makes me feel good in my trades.
Absolutely. Well, we have another caller on the line. It is Lee in Ohio. Good morning, Lee.
Hey, how y'all doing today?
Hey, Lee.
It's good to hear from you.
All right. I just, I talked to you when I was down at Wise Fest, and a lot of things that you were talking about, I was telling people and teaching people. But once I talked to you in the way that you really summed some things up, it just really just brought it even to light even more for me. Now, one thing it has did, it made me trade so much from a carefree state that if I see a fresh cross on a day and a good month and a good week, I get in it and I mess around and be in 20 different trades. but
could there be too much of a carefree state of mind?
You say what?
I was asking Mark if there could be too much of a carefree state of mind.
Well, I mean, I look at it, and it took me. I mean, the only thing that I don't play is earnings. Okay. And it took me to, and me and you were just talking about it yesterday, Jared. It took me to the mindset that I don't care what the market is doing. If I see the charts is right, I'm getting in, period. Right. I don't even think about nothing else. And it's so funny, when the market went down, I lost some money, and a couple of my friends called me, and they was like, you should sell everything. You should sell everything. Liquidate your account. And I'm laughing. I'm laughing at them. They was like, why are you laughing? I was like, I'm going to win some, I'm going to lose some. I ain't worried about it. I'll make it back. You know, and that was my mindset. And it's just funny that when you get that mindset, you don't just think, you don't even think about nothing else.
Yeah, Lee, it's important for you still to have a plan.
Oh, no, I got a plan. I got a plan now. No, I do have a plan.
And in Lee's defense, if there's one thing Lee has, it's a plan. But it's funny when you said the carefree state of mind. Yeah. I mean, that's more, now, what you do talk about is something called euphoric trading.
Euphoria,
That's euphoria. That's different.
Well, there could be something here with, there could be an element of that with you want me to cover that? Or
yeah, could you talk? I think it's a great idea.
Well, you know, all of us, let's put it this way. We talked about expectations in the first segment. Mm-hmm. It's like, you know, when an expectation is simply, you know, a mental representation of what some future moment in the environment is either going to look like, sound like, feel like, taste like, or smell like, okay? Mm-hmm. In other words, if I believe that the environment is going to be a certain way, the outside environment is a certain way based on my mental representation, if it shows up that way, if it shows up exactly that way, how do I feel? Well, universally, this is a characteristic that runs through all cultures. This is a universal human characteristic. How do I feel?
You're going
to feel good, right?
Yeah,
you're going to feel satisfied.
Good.
There could be a range of really positive emotions. Okay, and this is universal. And by the same token, the degree to which the environment does not conform to our expectations, how do we feel? A whole range, you know, like I brought up before: disappointment, dissatisfied, betrayed, whatever. Okay.
Yeah, usually it's extremes like omnipotence and like total failure.
Well, the thing is that all of us have this potential to flip into a euphoric state of mind. And a euphoric state of mind is one where, for whatever reason, whatever expectations we had, let's say the environment showed up in a way that far exceeded what we thought, and it's just like we're as high as a kite. And what happens is that these chemicals get get released in our mind and our body. And the problem with genuinely euphoric state of mind can be like heaven, literally like heaven on earth. Yeah. And the problem as traders when we're in a euphoric state of mind is that in a state of mind of heaven on earth, it is impossible for us to conceive that anything could go wrong. Anything. Impossible.
That's when the stops come off.
Impossible, exactly.
Risk increases.
And so, yeah, and I've worked with so many traders, and I can say that I've worked with traders who have, let's say, their threshold for euphoria was one winning trade. Okay.
Oh, wow.
And there are others who, you know, maybe a string of 4 or 5 winning trades or 2 or 3 winners and a big monster or whatever. But the point is that there's a state at which we can operate at normal confidence in which we can do all the things, stay in the process of trading, meaning that, you know, we're objectively executing our edges, we're predefining our risk, we're cutting our losses, we have a plan for, you know, taking profits on a consistent basis. And then when you flip into this state of euphoria, all that changes because absolutely nothing can go wrong. And as traders, that's one of the most dangerous places to be because even though you may perceive that nothing can go wrong, the market may not agree with you. And that's when we have this tendency to violate money management principles, where if we're a 1,000-share trader, we'll put 10,000 shares on, you know, we'll mortgage the house or whatever because the trade just absolutely, there's no possible way it could be a loser. And in these situations, what happens is that when we've got 10 times the amount of exposure than that we're used to, then all it takes is just a tiny, tiny little bit that the market can come against our position, just a tiny bit. Right. And we can go from the state of euphoria to a state of terror instantaneously.
Because of what you just said, you were a 1,000-share trader who now committed 10,000 shares to this trade because you were in this euphoric state.
Yeah.
When the thing flipped down, your loss is now way outside of what you call the norm.
Well, it doesn't even have to be a big loss. It doesn't even have to be. It could just be the fact that nothing could go wrong, and so therefore, you know, it just shatters the state of euphoria, so that we go from heaven virtually to mental hell instantaneously, and it puts us in a state of mind freeze where we just can't even get out of the trade, and we're just sort of watching the market take our money away and not able to do anything about it until something snaps inside of us and we get out. So
that mid zone. You kind of want to stay in that.
Yeah, you want to stay in normal confidence. And what I was picking up about Lee was that he may not be violating money management principles, but when he realized that he could trade from a carefree state of mind, he was kind of doing many trades. He might not have been planning all these trades out, and just going from, you know, instead of doing, if he's a 1,000-lot trader or a 1,000-share trader, instead of doing 10,000 shares, if he was just trading 1 or 2 markets, he's trading 20. Okay, right. You know.
So we have an email from Ed, the Philly Pip Collector. He said, did most of the knowledge that you're sharing today come to you from your mentor or mentors or from practical experience? How long of a period of time did it take you to trade without fear from the time you started trading with real money? Thank you again for the benefit of your knowledge and expertise.
The first part of the question is how long...
Who did you learn from, and how long did you trade with
Who did I learn from? I started writing The Disciplined Trader in 1982. There wasn't really back in 1982. There weren't even that many trading books available. So
this was a personal revelation.
So this was from your own experience that you're writing this stuff. This is all from my own experiences. Yeah, as a matter of fact, it had to do with you know, losing everything that I owned as a trader, and at the same time being in a situation where I was at Merrill Lynch, you know, where I was observing, you know, not only other brokers in the office, but the behavior of my customers, their customers, having relationships with floor traders, noticing these common themes of errors that we were all making, and then when I ended up losing everything that I owned, I was in a state of mind where I didn't have anything else to lose, other than maybe my job, because, you know, Merrill Lynch would have known the situation, and I'm sure they would have fired me, but they didn't, and so I was able to not trade anymore because I didn't have any money, but at least I still had access to the markets. I still had access to being a trader, and when people really genuinely tap out, they don't get to trade anymore because they don't have the financial resources to do it. Right. So I was in kind of a unique situation where one, and this I could probably explain it, but I'm not going to do it here, in that I just knew that trading was psychological right from the very start. It just made sense to me that it wasn't technical as much as psychological. So is it because of your observation of not only what was happening to you, but everybody around you, and then you had bottomed out?
Yes.
So you got rid of the fear there because you had already experienced.
Yes, I had extensive journal work that I did, and so in 1982, you know, when I came to these realizations about myself and about trading, and when I didn't have anything more to lose, everything about my trading changed because it was like the fear dissipated, and it's like I started making consistent money for my customers. Because I was doing the same things, but I was doing it from a different perspective, and not making the errors.
So the second part of his question referred to the time it took you to get over your fear, and you think it was more, or you say it was more like almost an instantaneous.
Well, yeah, it was an instantaneous, maybe an instantaneous realization, but it was because of these experiences.
Right.
And so what I started doing is developing the material that ended up in the Disciplined Trader. What I didn't anticipate, because I never grew up aspiring to be a writer or thought that I would be, is that, I mean, having very much of a trader's mentality back then, I would say, you know, okay, this is going to take me 6 or 8 months to do this. It ended up taking me almost 8 years, and it was tapping basically where this insight comes from. Is I tapped into the creative process. What I mean is I specifically stayed away from any other material that had anything to do with even psychology or trading. There wasn't really anything on trading psychology anyway, except for one book, Jake Bernstein's Investor's Quotient, that came out in 1980. But otherwise, I specifically stayed away from it because I realized if you ask yourself questions from a sincere space of being open to any answer that comes, you'd get any answer that comes. And so I was really developing this material as I was going along.
Very good. Well, we have another caller on the line. Good morning, Keith. How are you?
Good morning.
Keith,
I'm great.
What question do you have for Mark?
The question I have for Mark is this. You're speaking of learning to get into that carefree state of mind and starting small. You said, example, 10 shares to gain that consistency. When would you then increase it? I mean, 70%, 80%, then increase? What would be your guideline, or would you go by a psychological guideline? That's my question.
Interesting one. Thanks, Keith.
I'd go by a psychological guideline. In other words, when you can trade 10 shares perfectly, in other words, when you can set up a trading plan and execute that plan, when I mean perfectly, I literally mean not just execute the plan perfectly, but execute it without any conflicting or competing thoughts about what you need to do and when you need to do it. In other words, it wouldn't even occur to you to make a trading error. And then what you do is you move up to the next level and see how well you do.
Is P&L an equation here? Profit and loss, is that an equation?
Well, not necessarily. I mean, you can do an exercise like that and not even take profit and loss into consideration. That, in other words, there are many times I've set up for people, trading exercises that really didn't take into consideration how much profit they might have.
It was following the plan.
It was following the plan.
Because we know we're going to lose, Jared.
That's right. Right. It's
so
following
you can
the plan.
live with that loss and just keep moving forward.
Exactly. In other words, how well can you follow the plan? And then if you can follow the plan without any conflicting or competing thoughts to do other than what you set out to do, then you up your size. And if you're real comfortable right off the bat, you can up your size even more. But if you find you're not comfortable and you find yourself making trading errors or even thinking about making trading errors, then stay at that level until that doesn't happen anymore.
That's great advice. Thank you for that. We have another caller. Frank is the first time calling in. Thank you for doing that, Frank. What can we do for you? Frank, are you there?
These are good questions, by the way, that people are giving us.
Good stuff.
They really are, yeah.
Okay.
Yeah.
Well, I don't think we have Frank on the line, so let me go to one of our emails. This it says, since you cannot know that a trade will be a winner when you enter it for the same reason, can I assume that a profit target is the same psychology? Assuming that the next tick after I exit a trade, after reaching my pre-assigned target profit, will be a down tick is the same false assumption as when I enter the trade thinking that the next tick will be an uptick, that I must wait for the market to tell me that the trade is over. So it's kind of the reverse.
Yeah, there's no way to know how far a market's going to go in your favor. You just have to pick these predetermined spots, or if you don't pick predetermined spots, then use some sort of an indicator like another fresh cross or a trailing stop to get you out of your trades.
Very good. Okay, our next email is from Hal in Pennsylvania. And he says, hi, Jared, Mark, and Susan. On behalf of all the wise traders, I want to thank you for this great opportunity to listen to Mark. The question I have for Mark is, over the years, have you found that a day trader can be as successful as a swing trader or long-term trader, provided stops are in place and a good trading plan is in place?
It doesn't. It really how you categorize the way people trade is virtually it isn't even relevant. In other words, it depends on how you think about your trading and what you're most comfortable with. So
I would think that your trading style has to fit your personality and your time allotment.
That's right. Yeah. So a day trader who's got their mind right is going to be just as successful as a swing trader who's got their mind right, and a swing trader who doesn't won't be any more successful than a day trader who doesn't. So.
Well, Jared, you touched on something that earlier when I was watching the program, I thought we would ask Mark. If somebody is new to trading and they watch Wise Trade TV and they see that we have all different trade styles and we even have all different markets, a common question we get is, how do I determine what trade style is suitable for me? And how do you think that from a psychological standpoint? Not necessarily, maybe they can spend all day at the computer and they have time to do that. But for who they are, how do you help determine what type of trader is more suitable for their personality?
That's a good question. And it's kind of tough one to answer, too.
You'd probably have to meet the person.
For me, it's like even when you do personal consultations, it's like what I realize is that you can't put people into categories or pigeonhole them into certain boxes. That everyone's mental ecology is unique, and you have to respond to that kind of uniqueness. So how a person goes about determining what trading style is most appropriate for them would pretty much be based on what they're attracted to. In other words, even for me, for an example, for many years, I learned to trade as a swing trader because we didn't have access